Just getting some stuff set up on our end, and we'll probably start here relatively quickly. All right, so today's webinar is how to manage your finances, from budgeting basics and paying back your student loans to 401ks and retirement planning. We've got a lot of different topics that we're going to cover today, and if at any time you want to ask a question, you can simply type it in the chat box. And I just typed a little message in there. You see the names coming up as Ashley. It's actually me typing, so and I see them. So if you have questions, feel free to type in there. To get started, I thought it would be fun just to look at a hypothetical millionaire. A lot of people ask me, you know, what does it take to be a millionaire? Am I ever going to be or have $1 million? And the answer is that it's actually pretty easy to accomplish as long as you do some basic things and take some time to do the right kind of financial planning that you need to. So the typical millionaire in the U.S. is in his mid-50s. He has not received an inheritance, lives in an older home, about a 40-year-old home that he purchased about 12 years ago, and drives a 4-year-old American vehicle. The most common is a Ford F-150 and an Explorer SUV. And this information was taken from the book The Millionaire Mind, which was written by Thomas Stanley back in 2001. If you haven't read that book, I would strongly encourage it. It's an interesting read, and just talks about the mindset that people have around saving, those who end up becoming successful and saving for their retirement. So what makes a millionaire different? What are the primary things that they're doing that are different from the rest of us who haven't done the kind of planning that we need to? Well, number one, they don't have a high consumption lifestyle. They're not going out there and buying the latest and greatest gadget and flat screen TV, iPad, iPhone, all that kind of stuff. Now, that's not to say that you can't have those kind of things if they fit into the budget and you've saved for them appropriately, but they don't go into debt to buy those kind of things. They also tend to be well educated, tend to have a bachelor's degree or higher. So those of you who are in school, stay in school, get graduated, and you'll be part of this group. They're mindful investors. Typically, a millionaire will invest about 20% of their household income each year, and that's kind of a goal to strive for. Even if you're not doing it now, you could start somewhere and build up to that as the budget allows. Millionaires also tend to be planners and budgeters. They keep track of what they spend. They plan out big expenses that they have coming up. If you know that your car is going to break down or need replaced in the next couple of years, start saving for it now. Don't wait until it's finally on its last leg and then go out and get a loan for the full amount. Try and save something, even if it's not 100% of it. Try to save a little bit. Budgeting is something that we'll talk about here in a little bit, but budgeting your money is an important part of financial planning. You need to know where your money's going. A lot of people think, well, it's, you know, I'm going to Starbucks, I'm buying a $4 latte, no big deal. But if you do that on a regular basis, that starts to add up to big money over time, and maybe you could have gotten just the black coffee and saved yourself a couple of bucks. There's a lot of different tools online that you can use to budget your money and keep track of where your money's going. But the important thing is just to be cognizant of where everything's going, large or small purchases. So I've outlined 5 kind of overarching steps that people can take to have financial success, or at least improve their odds of having financial success. Protecting what you have is the first section that we're going to go through, and that kind of creates the ground level foundation for financial planning. Making sure that you are able to build your assets on top of a strong foundation is always an important thing. If you're saving money for your retirement but not for emergencies, and an emergency comes up and you have to tap your retirement, then it did you no good to save for retirement. So that's why we start off with protecting what you have. The next section we'll talk about is taking control of your cash flow, and that's where we'll talk about budgeting, making sure that your inflows and your outflows line up, and that hopefully you have more inflows than you do outflows. That's the goal, at least. Third step is to invest wisely. We'll talk about different investment tactics. Fourth is to manage your taxes. Taxes play a big role, especially in long-term savings, in how much money you have to set aside to reach those goals. And fifth, to save for retirement. We'll talk about what it takes to do that and what some of your options are. If at any time throughout this talk you guys have questions, please feel free to type them into the chat bar, and I'll stop and take time to answer those questions. So let's start with step number one, protecting what you have. The main thing that we're talking about here is insurance. And people have different feelings when they hear the word insurance. Some people think, well, it's a necessary evil. You got to have it for your car or your house or whatever. But some people think, oh, this is it's a bad thing. Insurance. They're out to get you. The answer is that no insurance is 100% right or wrong for any one person. We'll talk about some of the main kinds of insurance that you can have and why you might think about having them. First, I wanted to talk about a little bit about the basic belief, the fundamental behind insurance. And please excuse this crude drawing. Insurance, the concept for it first was started in China many years ago. There were farmers that had these very shallow little boats, and that's what you see. These are boats in a river with different shapes on them. Those shapes represent vegetables. And so if this one farmer who's growing this triangle-shaped vegetable put all of his own vegetables on his boat, and he was going down the river, and the river current picked up and the boat flipped over, well, then he lost all of the crop that he had harvested and was taking to market, and pretty much didn't make any money that year. And so what they developed was a system of transferring the risk of one farmer carrying all of their own crop onto spreading it out among multiple different farmers. And so each farmer would carry a little bit of each other's crops. So if one guy is growing carrots and the other guy is growing potatoes, and another farmer is growing corn, well, then each one of the boats would have a little bit of corn, a little bit of carrots, and a little bit of potatoes. And if any one of those boats flipped over, they wouldn't be a total loss for any one farmer. And so the idea behind insurance is that it's a transfer of risk. It's taking in lots of people, and not all of them, at least the insurance company hopes, will have claims all at the same time. And so for your car or your home insurance, you're insured with a pool of lots of other people who also own cars. And the insurance company is hoping that not all of you crash in the same day and need a check cut to you, but rather that a few of you will and most of you won't. And so that's the idea behind insurance to begin with. It's simply transferring your risk onto a larger group of people so that everyone is covered when something happens. Healthcare coverage is another main type of insurance that most people have. If the new healthcare reform laws go through, then everyone will be required to have health insurance. And also everyone will be able to obtain health insurance. Currently, there's quite a few folks who, simply because they feel they can't afford it, or because they don't feel that they need it, don't have health insurance. And then there's also a group of folks who, because they have health conditions that the insurance companies don't want to cover, will not provide them with health insurance. And so that's something that will be changing here in 2014 as long as the law stays in effect. The main two types of health insurance that people have are individual and group insurance. Group is something that's provided by your employer, whereas individual is something that you would go out on your own and purchase. The HSA option is something that has become pretty common for most people who are trying to control the amount that they spend on the insurance itself. HSA simply stands for Health Savings Account, and that account is paired up with a high deductible health insurance plan. In the olden days, most insurance companies had what was called a copay plan, where if you went to the doctor, you would pay a $20 or $30 copay, and the insurance company would pick up the rest. In a high deductible plan, you are on the hook for the majority of your regular health checkups and doctor visits up to a certain deductible amount, could be $5,000. And after that, then the insurance company will pick up the rest. With the HSA, it is a tax-advantaged way to pay for that first $5,000 of coverage that you're paying for on your own. You basically put this into an HSA account, which you can open up at any check or a bank or credit union here in town, and you get a tax deduction on the money that you spend out of that account. So that can be a great way to save a little bit on taxes and also pay for a cheaper health insurance plan. Disability income coverage is another category that a lot of people have provided through their work. Most companies provide somewhere between 40 to 60% of your income on a long-term disability basis. What you need to figure out is how much do you really need to cover, based on how much does your employer cover and what your budget is. If you're currently spending 100% of your income every month and don't have anything left over, well, then you probably need a lot more than the 40 to 60% coverage that your company provides, especially if you consider that most plans, if the employer pays for 100% of it, is still taxable. And so on a 60% coverage, you're probably looking at only receiving somewhere between 45 to 50% of your pay. And what would that look like to your finances? So that's another area that a lot of people choose to look at to help lay that foundation for solid financial planning down the road. If you consider that if you had a long-term disability and you were only living on now 50% of your income, would you still be able to fund retirement, pay for the kids' college, continue to keep the lights on and have the mortgage paid up and all that kind of thing? That's a big concern for a lot of people, and so that's an area that a lot of people take a look at. Life insurance is another big area that people take a look at. This is basically what happens when I die. What am I leaving to my family? What kind of financial situation am I leaving them in, whether it's a lot of debt or whether it's paying off the debt, and is it helping them stay in the house? Is it funding college? With my clients, we go through a needs analysis where we calculate what a person wants to cover and how much that total amount should be. Most people that I meet with also want to replace a portion of their income for their spouse or family, and so you need to add that on as well. There's two main types of life insurance. There's term and there's permanent. With term insurance, it's basically a life insurance policy that lasts for a certain period of time, typically 20 years. And at the end of that 20 years, your life insurance is over. And if you have passed away during that time, well, then the insurance company pays out the death benefit. And if you live past that, then you've paid in just to have that protection over that period of time. With permanent coverage, it lasts for the rest of your life. So no matter how long you live, if you live to be 100, the coverage will still be there. Most permanent plans also have a side savings account built into the insurance plan that they call cash value. These policies are typically more expensive, 12 to 15 times more on average, and that's because the insurance company knows that they will pay out at some point. Everyone dies at some point, and so they have to figure that into their overall financials. Neither term nor permanent is right for everyone. It's on an individual basis which type is more appropriate. Generally, what I find is that term is more appropriate when you're covering a temporary risk, whether it be while the kids are young or while you have a large mortgage or some other big debt that you want to cover, whereas permanent is a baseline of insurance that most people choose to have at some level throughout their lives. Permanent insurance can also be used as another tax advantage savings tool, but that's getting a little bit detailed for this conversation. At the beginning and at the end of these slides, I have my contact info, and so if you want to contact me after this with more detailed questions about what's more appropriate for you, feel free to. My phone number and email address will be listed on there. Long-term care coverage is something that's becoming more and more popular, especially as the baby boomers age and more people are living longer. Long-term care coverage is basically an insurance product that covers in-home care, nursing home care. It helps you avoid the Medicaid spin down that happens in order to qualify for Medicaid if you need to go into a nursing home. The statistic that's listed there at the bottom of the slide is a pretty staggering one. This came out by the Council of Economic Advisors in 2007. An estimated 70% of people who reach the age of 65 will need some form of long-term care before they die. Now that could be hospice care, it could be memory care, which would be for patients with Alzheimer's, could be simply assisted living, which is more of an independent living. But that's a pretty big factor that you need to figure into your overall retirement savings. How will that impact my retirement need, and am I putting aside enough to make it there? So that's the end of step number one. I'm going to pause for a second. Do I have any questions about what we've covered on the protecting what you have side? Okay, Thomas has one. I'll pause for a minute while you type there, buddy. So if everybody can see that chat box down there, Thomas has asked, is it better to have an employer cover life insurance or get it from another company? Well, okay, hang on, Sam, I'll answer your question in a minute. So, Thomas, to answer your question, it isn't inherently right or wrong to get insurance through your employer for life insurance or get it outside. What I typically advise my clients is it depends on the job stability that you have. If you're comparing group life insurance to term life insurance, the product is basically the same. It's there for a certain period of time. With an employer-based group benefit, you're at the whim of the company. So as long as they continue to offer life insurance as a group benefit, you'll have that coverage. Now, if they decide that next year life insurance is too expensive as a benefit to offer the company and they drop it, you now have no life insurance and need to go out and get it outside of work. The other thing that's come up, especially over these past couple years, is with job instability, people losing their jobs or switching employers or being unemployed for a lengthy period of time. You have no coverage when you sever employment. And so for most of my clients, it makes sense to get some policy outside of work to continue to cover you regardless of what your job situation is. The other concern that I have for people that carry all of their life insurance through their employer is that If down the road they do switch jobs or work for a company that doesn't offer life insurance and they have to go out and get it on their own, the older you get, the more difficult it is to qualify for life insurance on your own. There is an underwriting process that takes place. Sometimes there are medical exams that need to take place. And if you look at most people's health, they get more unhealthy the older they get. And so it gets more difficult and more expensive to purchase life insurance outside of work. If you're looking at a healthy 20 or 30-year-old as compared to a 40 or 50-year-old, even if they're still healthy, it's much more expensive to get coverage. And the probability of having some kind of high cholesterol, high blood pressure, gaining weight during that period of time is pretty high, and so the cost will continue to go up from there. The other thing about employer-based life insurance is that after you retire, generally, for 99% of the companies out there, your life insurance is now done. And the statistics show that most people pass away after they retire than before. And so that's where a small portion of whole life insurance, permanent life insurance, sometimes makes sense. Not always, but sometimes. Sam, your question is, are there any tax benefits to a regular 30-year term life insurance policy? The tax benefits of life insurance are that on the death benefit, that amount passes tax-free to your beneficiary. So the 30-year, it doesn't matter what the term is, the benefit of life insurance is that death benefit, whoever it be, maybe it's your spouse, maybe it's your children, would receive that money tax-free, as opposed to if you saved it in an investment account and then it gets inherited to the spouse or children. There are tax implications depending on what type of an account it is. There are no special benefits to a 30-year term over any other term. Typically, a 30-year term would be for a mortgage if you're getting a 30-year mortgage. However, that product is not as common as it used to be. The most common plan that I see these days are 20-year. Typically, the terms are 5, 10, 20, and then there are still some companies that carry a 30-year term. What some financial experts say is that during that 30 years or during that 20 years of the life insurance that you have, you should be paying down debt and building up investment assets to the point where you don't need such a large term life insurance policy at the end of that term. And so in a sense, you're self-funding at that point. Did I answer your question, Sam? Okay, excellent. And feel free to stop me throughout this if you guys have any other questions about that section. So step number 2, take control of your cash flow. Basically, what I'm talking about when I say your cash flow is that this is your money coming into you and the money flowing out from you. So that would be any money you receive from your employer, any investment gains that you have coming into you, and any bills that you're paying out on a monthly basis, any expenses. And so the first step is simply to track your monthly expenses. And I kind of put this tongue-in-cheek here, but I think it's very appropriate for especially American society, is spend less than you take in. Not rocket science there, but I'm continue to be amazed by the amount of debt that people carry into their 40s and 50s when they should be budgeting and spending less. Tracking your monthly expenses can be as simple as taking out a notepad and writing down every time you spend money. Some people use a debit card or a credit card for everything, and so it's very easy to then, at the end of the month, put that into a spreadsheet and sort it out by category and figure out where you're spending things. Some people use software like Quicken or Mint.com. The Mint, I think if you Google it, we'll find it that way, which is budgeting software that you can use to plug everything in, and it will categorize it. The idea there is simply to pay attention to where your money is going. When my wife and I first started budgeting years ago, we were amazed by some of the categories and how much we were spending in them. One of them was going out to eat and entertainment. When you go out to eat a couple of times a week at 20 or 30 bucks a pop, it really starts to add up on a monthly and especially on an annual basis. And when you compare that to eating at home or eating somewhere a little bit less expensive, it really can make a big difference and can allow you to accomplish those financial goals that you're not currently able to. The categories that people overspend in or spend more than they think they should can vary from person to person. For some people it may be the extra premium channel cable package that you have, or the extra unlimited data plan that you have on your phone. And I'm not saying that everyone should cancel their cable or only have basic phones with no data package, but what I am saying is that if you're not accomplishing your other basic financial goals, whether it be paying down debt or building up an emergency reserve in your savings account, you need to look hard at some of those things and not just try to keep up with the Joneses and say, well, everybody else has got an iPhone, so I need one too. The second thing that should go into keeping track of your cash flow is to build that emergency cash reserve. Anywhere between 3 to 6 months worth of expenses is appropriate for an emergency cash reserve. I would say at a baseline that everyone should start with at least $1,000 in their savings account. and not all of you have that right now, and I completely understand. I was there once. I have been a college student, or was a college student, for many, many years. It takes a while to get there, and the idea isn't that tomorrow you have it, but the idea is that you're working towards it. Whether it's 5 or 10 bucks a month or 25 or 50 bucks a month, whatever fits into your budget, you should be socking away into your savings account. The idea behind an emergency savings account, emergency cash reserve, is simply that when those emergencies come up, you don't have to rely on credit to pay for those things. Whether it be the tire blows out or the alternator goes out, it seems like car trouble is the number one factor that has an emergency associated with it. But it could be anything, any unexpected bill that comes up. That's where that emergency savings account comes into play. Now, when you get to the point where you're building up 3 to 6 months worth of expenses, that's more for the big things that come up in life, and a job change or a stint of unemployment are the big ones that have happened over these past couple of years that a lot of people have found that beneficial. But it could be larger expenses if you own a home and the air conditioner goes out or the roof needs replaced. Those are all big things that you weren't necessarily planning on, although some of them you probably should have been. I've got an old air conditioner that I should be saving up for right now. But there's a lot of things that as life goes on, things get more and more expensive, and so it's good to save for those bigger expenses as well. The third bullet I have there, pay down debt. That's kind of an obvious thing, but there is good debt and there's bad debt. Now, people can argue all debt is bad, and that's perfectly fair, but what I mean by good debt and bad debt is that there are some things that are tax advantageous and some things that just plain cost you money. An example of a bad debt would be credit card debt. There is absolutely no tax benefit to holding credit card debt. The interest rate that most people pay on credit cards is extremely high. A good debt would be considered student loan debt or a mortgage, where under current tax law you receive a tax deduction when you pay student loan interest or mortgage interest. Now, I'm not saying that you should go out and try to find more mortgage debt and student loan debt, because obviously you don't want to have any debt, but those would be better debts to have than credit card debt or other car loans or things like that. When looking at how to pay down debt, there is a concept called the debt snowball. And if you Google debt snowball, there's many web pages on it, and Dave Ramsey, if any of you have heard of him, in his Financial Peace University course, teaches basically the debt snowball. The idea there is that you line up all debts that you have by balance, from smallest balance owed to largest balance owed. So you may have a store card at Best Buy or Kohl's or Macy's that has a couple $100 on it, and you may have a car loan and then a mortgage. Well, the store credit card would be the first thing on the list, the car loan would be the second, and the mortgage would be the third based on the amount that you owe. The idea behind the debt snowball is that you pay any extra money that you have in your budget towards that smallest debt, and you pay the minimum on all the others. When you get done paying off that first debt, you take everything that you were paying on that one, add it to the minimum on the next one, and so it creates a snowball effect. It gets larger and larger the further down your debt line you get. This is a much more effective way of paying off debt than paying extra on the largest one or paying extra on the one that has the highest interest rate. And you can work this out mathematically, and it shows that you actually pay off debt faster, and you also keep motivated about paying off debt because you're continuing to pay off the next one and the next one, and they're actually attainable at that point. So the idea, obviously, in any good budgeting is to reduce the amount of debt that you have to as near zero as you possibly can. When you're doing monthly budgeting, these are some of the categories that you might choose to include, and if anyone wants to, they can shoot me an email. I have an Excel worksheet that has all of these categories pre-populated in it that you can just fill in the amounts to. But things like housing, whether it's rent or mortgage payments, food, you could break that out into groceries, restaurants, automobile. There's several categories in there that go into owning a car. Clothing, utilities, credit card payments, savings, student loan payments, child care, insurance, entertainment, medical bills, and so on. You can obviously make up your own categories, so if you've got some unique category to you that you make your own budget worksheet that fits into you and what your monthly budget is. And if there's some of these on here that don't fit into your budgeting, then simply take them out. But the idea is that it's good to track. Rashonda asks, what were some of the software programs you can use on the computer? If you Google the Mint, M-I-N-T, that is a online free budgeting software that also has a lot of great resources for you. But you can do something as simple as creating an Excel spreadsheet or a Word document that you type in the categories and type in what you're spending. And if you Google free budget software, I'm sure you'll find quite a few of them out there as well. The Mint is by far the most popular as far as when I talk to my clients as to what they're using. So how do you cut some spending out of your monthly budgeting? A lot of people ask me, okay, well, I put together my budget. I know I'm spending too much, but what do I do to make it a smaller budget? Well, you can shop around and compare prices. There are apps on smartphones now where you can actually scan a barcode and it will look up prices on the web and at surrounding businesses to find out if you're paying the cheaper price or if you could drive across the street and get it cheaper. The web is obviously a great resource for that. Googling big purchases before you buy them, and a lot of times you'll see comparative prices on different companies. Making a shopping list and sticking to it. That is probably one of the toughest things that my wife and I struggle with, especially with a young daughter going to the grocery store. It seems like everything that my daughter would possibly want is at her eye level. And so we always end up with more things in the shopping cart. And I would be remiss if I didn't say that that was also my fault in not sticking to that shopping list at the grocery especially. But I have some clients who are very successful at preparing out a meal plan for their family prior to going to the grocery, seeing what they already have in their pantry or their fridge and what additional things they would need to make meals out of those items. Oftentimes we wind up with some mismatched things in our pantry that if only we had one or two more ingredients, we'd be able to make a great meal out of it. And so doing the preparation ahead of time Also allows you to find coupons. If you've got a stash of coupons, then you can go through them all. It's going to take some time to go through all that and create that list, but it depends on how tight you're trying to be on your budget and how much you're trying to save in order to accomplish your other goals. Preparing meals and bag lunches at home, always a great money saver. It's much cheaper to eat at home, especially much easier to eat healthy at home than it is going out to eat. Don't shop recreationally. My wife and I joke about end cap buying, which is an end cap is the edge of the aisle where they put all the big items that are on sale or proposedly on sale. We always joke that you need to go down the actual aisle where they're selling those and compare the other name brands to see if you're actually getting a deal or not. And so we've made a joke out of that at the grocery store whenever one of us is tempted to pick something up off of an end cap. You can use the public library for books, magazines, and videos, so you don't need a subscription to Netflix or to Blockbuster. You can actually go to the library and rent DVDs, or I don't know if they still rent VHS tapes or not. Maybe I'm dating myself on that. But you don't need to buy a book. You can get it from the library. Magazines the same way. I don't think you can take magazines home, but you can still sit there and read them in a nice, enjoyable fashion. Bring your coffee in from Starbucks and read a magazine at the library. The lowering your thermostat when you're away or when you're sleeping is actually a huge way to save money, especially as we get into the winter months. Your energy prices are going to spike again, and simply adjusting it a few degrees will end up saving you a lot of money. And maybe you need to wear a sweater around the house instead of walking around in a t-shirt, but and maybe you don't need to go that extreme either. But there's definitely some ways to save on your energy. You could try walking instead of driving. If you park your car and walk into a location instead of doing a drive-through, you actually save gas. If your car idles for more than 10 seconds, you have used more gas than if you were to turn it off and turn it back on. Just a fun factoid there. And also look for a free bank account. Obviously, this has been in the news a lot recently with the bank switch day, with some of the major banks proposing new fees and looking at switching to some more regional or local banks or credit unions. There's certainly, we are blessed in Fort Wayne to have a lot of really great local and regional banks and credit unions that offer free accounts, free checking, free savings, that kind of stuff. If you are paying a fee for having a bank account, then you need to look at switching to a different company, or go in and talk to your company and see what you can do to change that. It's those little things, and if you only take one or two of these things, they can add up to a sizable amount of money that can really impact your financial goals. Okay, step number 3 is to invest wisely. Seems like common sense. Don't put all your eggs in one basket. That's probably the most overused cliche in my industry. But basically, what I'm trying to say is diversify your investments. When we read the news or see on the evening news that these people were bilked out of millions from Madoff or these other investment schemes, first of all, that isn't the majority of us that are investing. We don't invest in those kinds of investments, but it brings home the point that you need to diversify your money among different types of investments. Now, this list here, stocks, bonds, mutual funds, international, domestic, cash, money market, real assets, I'm not saying that all of these are right for everyone, but most people have money in a couple of these different types of investments. A real asset, the one at the bottom there, would be your home. Is a real asset. Some kind of, if you bought gold bars, that would be a real asset. Certainly not encouraging that, but if you did, that would be a real asset. Any collectibles, things that are appreciating in value, would be a real asset. Cash and money market would be your emergency savings at the bank. And the top 3 are more investment oriented for different savings goals like retirement. Step number 4, manage your taxes. Taxes can make all the difference. So I'm going to stop here and read what Rashonda wrote. What are the pros and cons in opening an IRA through a bank, and would it be smart to have both an IRA and a 401k? That's a great question, Rashonda, and we're actually going to talk about that right now. Hey, how do you like that? Perfect timing. So, the different, depending on what your savings goal is, you will save or should save in different types of accounts. So, your emergency savings, something that you want to have liquid access to at all times, something that you don't want to be subject to market volatility of fluctuating up and down in the market when you need it most. Those are things that you would typically put into a checking and savings account or a CD. In anything in that left-hand column where it says taxed now, those typically are for shorter term investments. And the reason for that is that you pay more taxes the more liquid you want your money to be, the more free you want to have access to your money. And so, for instance, in a CD, in a taxable mutual fund account, in an individual stocks or bonds, and even in a savings account, any interest or dividends that you receive on that money, any realized capital gains that you have from buying or selling one of those, will result in you paying taxes at the end of the year on your tax return. Now, the reason you do that is because you want easy access to that money. You want to be able to get at it. But the downside is that on a long-term savings look at the taxes, you're actually going to end up paying much more in taxes and not be able to save as much as if you were to look at some of these other options. So in the taxed later in the middle column, we've got things like a traditional IRA, a variable annuity, a fixed annuity, a 401k, or a simple IRA. These are things that you put money into on a pre-tax basis, meaning you have not been taxed on them yet. And in all of this tax, we're talking about income tax. When you go to pull money out of these accounts, whether it be in retirement or pre-retirement, you're going to pay income tax on the money in the account. Now, the benefit that you have over that type of an account versus a taxable account, like in the left column, is that that tax is all deferred. You don't pay it on an annual basis. You only pay it when you pull it out. And that allows the money to compound on itself and grow on itself at a much quicker rate. So those are definitely a long-term investment savings vehicle. Now, if you compare that to the column on the right, tax advantaged, you've got things like a Roth IRA, whole life and universal life insurance, which is that permanent insurance we were talking about, and 529 plans, which are a college savings vehicle. Those are things that are tax advantaged. On a Roth IRA, the money goes into the account after you've already paid income tax, so the money that's already been taxed out of your paycheck would then go into a Roth IRA, and all of the growth in that account comes out 100% tax-free. The benefit of that over a traditional IRA or a 401k is that if tax laws change down the road, or if you're in a higher tax bracket down the road, you will end up paying less tax by getting the tax out of the way today rather than 20 or 30 years from now. Now, to your question, Rashonda, about opening an IRA through a bank and having an IRA and a 401k, whether you open an IRA through a bank or another financial institution doesn't matter. Typically, the IRAs through banks, now I say typically, not always, will be in some kind of fixed investment like a CD. And if this is long-term savings money and you have a while before you're going to retire, a CD is probably not the best option. It is conservative and generally considered more safe, but most people choose to be in mutual funds in an IRA. An IRA and a 401k are basically identical as far as the tax structure. Both of them are pre-tax, and so you would not typically invest in both at the same time. Now, you would invest in a Roth IRA and a 401k at the same time, because then you have pre-tax money and after-tax money, and you can use those to hedge against any income tax fluctuations when you're in your distribution phase, when you're pulling money out in retirement. What most people do with their 401ks when they leave a job is they roll it over into a traditional IRA. So you keep it in the same tax status, but now an IRA, which stands for Individual Retirement Account, is under your control and not your former employer's. Sam has a question here. Are most IRAs and annuities compounded annually, quarterly, or monthly? Can you find accounts that are compounded more frequently? Sam, the answer is it depends. And what it mostly depends on is when the growth or dividends are paid out into the account. Typically, a mutual fund will pay out a dividend on a quarterly basis, same with stocks. If that money is reinvested into the account, that would be compounded. But depending on what type of an investment you're in, whether it be an account at the bank, or an account invested out on the market, it just depends on how it's compounded. Most people are adding money to their accounts on a regular basis, and so you've got that addition as well that is helping to compound on any growth that you have. So there's a lot of different types of accounts that we've talked about here on this slide, and it's important to sit down with someone who you trust for expert advice on financial planning to decide which type of an account is the most beneficial for you, depending on what your savings goal is and what your risk tolerance is, how much risk you want to take in the investment. So this is a tax comparison between someone who saved money in taxable mutual funds, that is accounts that are taxed on an annual basis, as compared to a 401k, which is a pre-tax investment, and a Roth IRA, which is an after-tax investment. Now, I used round numbers here. I did not try to go out exact out to the dollar. But basically, this is a 30-year-old person who wants to retire on about $50,000 a year at age 65. If that person saved in mutual funds in a taxable account, they would have to put aside about $35,000 per year to reach that goal. That's $35,000 for the next 35 years every year. And this is given about, I think I factored this in with about a 6% return rate and a 25% tax bracket, which is pretty typical for this type of person. Now, if they were to put this money into a 401k, they only have to put aside about $25,000 per year. That difference between $35,000 and $25,000, that $10,000, is simply because that tax is not paid out on an annual basis, and that money continues to grow inside that account every year. If you put that money into a Roth IRA, the number drops further to $18,000. And that's because you're getting the tax out of the way now. You don't have to pay any tax when you pull it out, and that money basically grows tax-free inside the account. Now, because a Roth IRA is such a good deal, the IRS actually limits how much people can put into it each year. The current cap, the maximum that you can contribute to a Roth IRA is $5,000 per year. Now, that can be adjusted from year to year. The IRS hasn't adjusted it in the past couple of years, but that is the current cap. Now, if you're married, husband and wife, both working, each of you can put in $5,000 for a total of $10,000. In a 401k, your cap, the maximum you can put in 2011, this current year, is $16,500, and the IRS has increased that for next year to $17,000. In a taxable mutual fund account, you can put as much as you want in, because the IRS is getting their money every year, and so they don't care how much you put into those accounts. So that's just some information to know that most people use a combination, and it all depends on what savings goal you have. There are also limitations on who can participate in a Roth IRA. There are income limitations, so people that make too much money can't participate in a Roth IRA. And so you have to look at other types of tax savings vehicles for that. So, step number 5 is save for retirement. How do we do this? Well, we've talked about the tax-advantaged ways to save for retirement, but to take a step back, really you need to sit down and think about what does this financial goal look like. And you can use this 5-step process for any financial goal that you have. Step number 1 obviously is to envision that goal. What do I want this to look like? And we're just going to use retirement as an example here. What do I want my retirement to look like? When do I want to retire? Where do I want to live? Step number 2 is to estimate your expenses. If you're living in Fort Wayne in retirement, you pretty much know what cost of living is going to look like. If you're moving to LA or Florida, cost of living changes. Housing could be more expensive, could be less expensive. You have to adjust for that kind of thing depending on what your plan is. Now, if you're 18 years old right now and thinking, Jesus, retirement is a long ways away, I don't have any idea what that's going to look like. Well, plan on something. Just say, hey, I have a goal here, 65, I'm going to retire. I want to live on $30,000 a year. At least you have something right now, and there's nothing wrong with changing that down the road. Step number 3, to evaluate your resources. This is basically looking at your budget. What can you afford? Where should I put my money, and how much does it take to put money into that account? Typically, a 401k, the minimum you can put in is 1% of your income. On a Roth IRA, typically it's somewhere between $25 to $50 per month is the minimum to put into a Roth IRA on a monthly basis. Other investments, buying an individual stock or something, may be a higher threshold, depending on how you're buying it and where you're buying it. So evaluate what you can afford to do, what resources you have to put towards that. Earmark guaranteed income. Now this is something that a lot of people don't have access to currently. These are pensions and other things that you know you're going to have coming in. Social Security would be in this category. Most people under age 30 have the viewpoint that I'm not going to count on Social Security to be there, and so that's just going to be a bonus if it is. My guess is that it will always be there at some level. However, my guess is also that it will you'll have to work longer to get it, have some kind of threshold of income to qualify for it, and it probably won't be there at the same level that it is today as far as a monthly amount that it's currently paying. But looking at some form of guaranteed income is a good idea. Annuities are a popular type of guaranteed income that people look at, where you put a lump sum of money into an annuity and say, okay, I want this paid out every year. I want X number of dollars paid out for the rest of my life. And that's something that people choose to put money into. Step number 5 is to ensure you're taking action. No matter what the amount is, try to do something. Even if it's $5 a month into your savings account for now, it's better than sitting back and saying, well, because I don't have $10,000 to put into an investment, I'm not going to do anything. So it's a great idea to do something, no matter how big or small it is. And that's something that working with a financial advisor or going online and doing some research can help you determine where the best place to put your money is at this point in time and what the things are that you're going to be looking at down the road. Now, to take that step 5 to heart, I put this spreadsheet on here. Now it may look kind of funky because I had to stretch it out, and hopefully it's big enough for all of you to see. This is basically showing you what the cost of waiting is. This shows 2 different people. Person 1 begins at age 25 and makes deposits of $2,000 per year for 10 years. Person 2 waits 10 years and then starts putting $2,000 deposits in for the next 30 years. And so in the left-hand column, you can see deposits of $2,000 for 10 years. This assumes a 6% rate of return each year. Now, this is a complete hypothetical. Most accounts would fluctuate up and down, not just simply guarantee 6%. At the end of that 40-year period, person one put in the $20,000. They put in $2,000 for 10 years, and their account grew to $151,400. You guys see that at the bottom, second column, all the way at the bottom where it says total deposit, $151,400. If you look at person two, who waited that 10 years, they sat there on the sidelines and said, oh, the market's kind of shaky, I'm not sure if I can fit this into my budget, I'm just going to wait until things look better. They sat around, and then in year 11, they put $2,000 in for the next 30 years, so a total of $60,000 they put into their account. So they put in triple what the first person did. And you can see at the bottom right column, right above total deposit, it says $156,116. They only gained an additional $5,000, and they had to put in $40,000 more to do it. All because they waited 10 years. My point with showing you this is that this should be a wake-up call to anybody who is not currently saving money. No matter how big or small, start now. $5, $10 a month, $25, $50 a month, whatever it is, do what you can now. Every little bit saved out of your budget can positively impact this number so that you don't have to work so hard later in life to save for those financial goals. When I first saw this sheet, I was kind of shocked, and I had to redo it and make sure that the math actually added up correctly, because that's a pretty staggering difference. And I see it all the time in my industry. When I'm working with folks who are in college or recently graduated and their budget's kind of limited, it's their first job or they're working part-time and all they can afford is $25 a month, I pull this out, and it's pretty impactful, especially when then I sit down with the 30, 40-year-old who hasn't been doing anything for the past 10 years, and then all of a sudden wants to. They've got to put in a lot more money to get that same goal. Okay? So those are the 5 steps that I have to financial success. I'll put up, there's my contact info at the bottom of that screen. Feel free to give me a call, shoot me an email. You can look me up on Facebook or LinkedIn. I'm happy to chat with you. My advice is always free. There's no charge to sit down with me and have a consultation, so I'm happy to be of service there. But at this point, any other questions, please feel free to type them into the chat, and I'll stay on here for a while and answer those. So Sam has a question. I was wondering if it is smart to pay off student loan debt in the first 10 years, or should you pay less and stretch that out over the greater number of years? The answer, like most of my answers, Sam, is that it depends. It depends on what you're giving up in your financial budget or in your planning to pay off that debt. Now, like I said, everybody's goal should be to be debt-free. We shouldn't want to have debt. With student loan debt, that is a better type of debt than most. Number one, because you get the tax deduction for the interest that you pay on the loan, which doesn't zero out the tax. You still pay tax, or you still pay interest on it, rather. But number two, you can also put your student loan payments on deferment, which is something that you cannot do with other debts. If you call your car company and say, hey, I'd like to not pay my car loan for the next 6 months, they will laugh at you and then start the repossession process. So you do have some flexibility with student loans, but my recommendation would be to balance that with the other goals that you have. If, in answer to your second part there, Sam, I would say if it was a credit card debt or a car loan, perfectly legitimate to pay that off before saving for investing. Simply because if you're paying 18% on a credit card, I can't get you that in the market. And so it would cost you more not to pay it off first. On a student loan, typically the interest rate is pretty low. We can usually beat that in the market. Now this year it's been flat, but most years we can beat that. And because of that deduction, I would say balance it, do both. But do the debt snowball. Line up your debts from smallest to largest, and if the student loan is all you got, put extra towards it. but don't do that with and not put money into your emergency savings account and not have the right type of insurance protection that you need. And you know, it's wise to do a little bit of long-term saving as well. Absolutely, Sam. My pleasure. Any other questions? Okay, well, like I said, I'll stay on here for another 5 or so minutes if anybody else has other questions, but you can always feel free to shoot me a message and I'll be happy to respond. Phone, email, social media is always good, but otherwise the presentation is over. So thank you very much for your attention, and good luck to you in your financial planning.